Hi, everyone. Good evening. Thanks for joining us. And I'm sure there's people from all over the world here dialing in. I saw on our registration list we had about 9 different countries. So wherever you are in the world, good morning, good afternoon, and good evening. We've prepared quite a lot of information here, so I want to kind of get started as soon as possible. This session will be recorded and reposted onto our YouTube channel. So without further ado, I'm going to begin by introducing the South African Chamber of Commerce in Singapore. So I've been part of the South African Chamber of Commerce since we started it in 2019. And, we've been going now for almost 6 years. And I'm very proud of the progress that we have made. When we started, we had no idea on the scale that this thing would get to and the speed of which it would get there. So right now, the South African Chamber of Commerce is connected to other South African chambers around the world. So we have connections to the Chamber of Commerce in South Korea, to the one in the UK, to the one in the US, and a whole broad host of other chambers and business associations of South Africans living abroad. And what we aim to do is to promote trade and industry between Southeast Asia, using Singapore as a hub, and South Africa as a hub and a gateway to Africa. So in terms of our board of directors, we've got a really great array of people here that have contributed their time, their effort, their energy, and also are paying members. So they're contributing money out of their own pocket. And we are a collective, a board of directors aimed at kind of delivering this value to our business community here in Singapore and in South Africa. So we also have a range of subcommittees which are completely on a volunteer basis, where we have all kinds of focuses in terms of agriculture and commodities, tech, women in business, legal and finance, all various different subcommittees where we have people in very big positions giving their time and opinion on a specific topic. And these are just a few of our wonderful subcommittee members who contribute their time. So if you're on the call, thank you very much. We appreciate you guys. In terms of our corporate members, we're completely funded by our members. We're a non-profit, and for that reason, we're really grateful to have the support of these companies who are members and who get a great amount of value from working with us. As the platinum sponsor, my company, St. James's Place, we have been with the chamber since the beginning, and I've been the platinum sponsor the whole way through. We're also supported by many large companies across the world and different intergovernment organizations. And through that, we have a great reach to the South African government as well as the Singapore government. And it's been a really great ride so far. So that's the South African Chamber of Commerce in Singapore. Today, we're going to be talking a lot about taxes and insights and strategies for tax planning for South Africans living around the world. And I couldn't do that without our guest speaker today, Marisca. Marisca de Bruyn is also a member of the chamber, and she has been doing this webinar with me for the last 6 years. This is our 6th one that we're doing together, so couldn't do it without her support. And today we're going to cover off a very quick summary, high level of the budget that just came out. But what I really want to do today is focus a lot on key insights for South Africans living abroad. From what we could see, there's only one real change in the budget that's going to negatively impact people living abroad that are going to be returning to South Africa. So we're going to highlight just that and then move on to the actual main bread and butter of our presentation today. So without further ado, Marisca, could you come on and introduce yourself quickly and this change that's happened in the budget with Section 10.1 GC?
Yes, thank you, Michael. So I'm Marisca Bruyn. I'm a tax advisor and I specialize in non-resident and expat tax. So that's obviously what we are going to be talking about today. And the big impact of the proposal that they are making in terms of foreign pensions is that generally how it works is if you contributed to your foreign pension while you were employed in a foreign country, generally this is exempt from tax in South Africa if you would become a tax resident in South Africa after that. The proposal is to amend that, take that away, and mostly the reason for this is because it results in a double non-taxation. So the double tax agreement between certain countries would say which country has the right to tax your pension in which country. So you could become a tax resident of South Africa, and the double tax agreement would say that only South Africa has a right to tax this pension, which means your foreign country, it's exempt in that country. And then on top of that, South Africa has another exemption, which says that foreign pensions contributed towards while you were a non-resident is not taxed in South Africa. So they are looking to amend that, and that will obviously have a big impact on people who have contributed to their foreign pensions and wanting to retire in South Africa. That plan might now not work out so well anymore.
And this is something that Mariska and I have used in a number of our client planning scenarios with people who have perhaps worked in the UK, built up considerable UK pension, and then were considering to relocate and retire in South Africa. Those people will no longer be enjoying the benefits of this exemption, it sounds like. So that is quite an important thing to factor into your overall retirement planning when it's time to go back to South Africa if you do have qualifying overseas pension schemes. So now, onto the actual bread and butter of today. Mariska is going to go through a quick introduction to herself and her business, Mint Accounting and Tax Advisory.
Okay, so at Mint, we specialize in tax. We're also an accounting firm, and we've got a strong focus on expat and non-resident tax matters. So we help people to cease their residency, do the whole tax migration process, and specifically helping them to do their capital gains tax calculations in terms of tax migration. We apply for various types of tax directives that non-residents need. And also we do tax advice on offshore structuring, which is very important if you're going to be a non-resident and having all sorts of things all over the world. So our services include, but it's not limited to, we do expat tax and the tax for non-residents as well. Also, what we do in terms of capital gains tax is when non-residents have sold their properties in South Africa, then we can help them with 0% tax directives. And also, like going back to the pensions, in South Africa, sometimes your pension can be exempt from tax in South Africa because it's taxed in the foreign country. And we help people with those kind of tax directives as well and exempting their tax. And also estate and succession planning, normal accounting, and individual tax as well. I can honestly say that we are trusted by South Africans worldwide. And the reason for that is because we have a deep understanding of SARS regulations and international tax treaties, which helps clients make informed decisions when they have, everything in South Africa and in the foreign countries. So we definitely help people just to formalize their South African matters and give them great tax advice because of our deep knowledge.
Personally, being a client of Mariska's and her helping me figure out my tax situation and moving my pensions offshore and doing the whole process, I can vouch for that. It was really good experience, as well as more than 50 of my clients who have worked with her and had a pretty positive experience too. No bad experiences yet, Mariska, so keep it up.
Thank you, Michael. I appreciate that.
So just my turn to just quickly do a very quick introduction to me and my company. So I work for St. James's Place, and we're an offshore financial planning business based in Dubai, Singapore, and Hong Kong. Our headquarters of our main business is in the UK, and we are the largest wealth manager in the UK. So in terms of myself, I'm a certified financial planner from South Africa. I'm also a general tax practitioner, although I do refer all of my tax business to Marisca because she's an expert. A lot of my clients have assets and estates that are across the world from South Africa, UK, Australia, Singapore, Hong Kong, China, Dubai, and further afield. But my focus really is holistic financial planning, where we look at where you are today and where you want to get to, and we bring your whole estate together in a packaged way that is going to be tax efficient and to achieve your objectives. So in terms of my firm, as I say, we are the largest wealth manager in the UK. We have more than 1 million clients. We manage more than 190 billion pounds. And we have an annual client retention rate of 94%, which in financial services is really good. Outside of this, we offer something that I believe is quite unique, is we guarantee the suitability of the advice that we give. So if we say that something is going to work a specific way, and that goes through a rigorous due diligence process and is proven to be suitable for a client, the client accepts the advice, proceeds, and works with us. If it comes to the time when that actually doesn't work out the way we said it would, the company will stand behind that advice and make sure that the client is right. So again, in financial advisory and financial planning, this is a unique aspect of our business and something I'm very proud of. In terms of our track record, so as you can see, this is our assets under management or funds under management, and they really do grow. And the reason for that is we do a lot of intergenerational financial planning where people will work with us and then their children will work with us and then their grandchildren. So basically the money will stay with the business and grow considerably over time. And that has to do with our 95% client retention rate. So in terms of our investment reach, we have the ability to work with the very best fund managers all over the world, from far-reaching as 91 down in Cape Town to Nippon Value Investors in Japan to KKR as a private equity firm in the US. My job really is to work with clients to understand where you are today and where you want to go and help you build the roadmap to success to get there. And a very big part of that is obviously tax. And as a South African leaving South Africa and going abroad, there's a huge amount of fear mongering where people come out and say, if you don't do this or that, SARS is going to tax you. And they really go about trying to make it a very scary experience for everyone. Marisca and I have made it our mission for the last 6 years to kind of take that fear away. It's just be aware of the systems, the processes, and work through it. And there's actually nothing to fear. So with that being said, Marisca, over to you to talk about those very processes.
Thank you, Michael. So what I want to start with, and I'm not going to spend a lot of time on this because we've done this so much. I think a lot of people understand this. So just a quick summary of how you can seize residency is the first test that we look at in South Africa is your ordinarily residence. And this we refer to as what is your intention for the future? Do you intend to come back to South Africa? And if not, then you break ordinarily residence, and that would be on the date that you left South Africa or on the date that you made that decision. But if you do plan on coming back to South Africa, because maybe you're only on a 5-year contract in Dubai, or maybe you say, I'm going to work all over and I want to come and retire in South Africa, then you remain an ordinarily tax resident. And but you can still break tax residency, because the second test that we then look at is the tax treaty that we have between South Africa and the other country. So what we look at is the other country's unique set of rules of how you would become a tax resident in that country. For example, if you spend 183 days in the UK of their tax year, you would become a tax resident of the UK. So now you're an ordinarily resident of South Africa. That means you're a tax resident. You're a tax resident of the UK because you met their days, and you can only ever be an exclusive tax resident in one country at a time. So what we then need to do is we look at the double tax agreement between South Africa and the foreign country, and there's a tiebreaker clause to determine which country can then win you as an exclusive tax resident. So the questions we ask then is, where do you have a permanent home available? And obviously that is then, like for this example, in the UK, because you live there, but you can also have a permanent home in South Africa if you still have a property that's just open and available to you. You can walk in there any day, then you have a permanent home in South Africa. But as with most people, either they are renting their properties out or they sold their property before they left South Africa or at any time. So then they don't have a property. In that case, if your only permanent home is in the UK, then you break tax residency in South Africa, regardless of the fact that you do intend to come back in the future. So it could be a temporary cease of residency. If you do have that permanent home available to you, then we look at the second question, such as, which is, where's your center of vital interest? And in this test, we look at, where's your wife and kids? Did they go with you? Do you have employment? Are your kids going to school there? Where's your personal and economic ties the strongest? So if that's in the UK, you break tax residency. But if it can still not be determined because it's in both countries, we look at the habitual abode. So where do you spend the most time? And in today, we get a lot of people who say to us, I want to spend 6 months in South Africa and 6 months in the UK, want to come enjoy the summer in South Africa. Then they could still be a tax resident in both countries. And I would then always just say, spend more time in the one country than in the other country. If it can still not be determined here, we look at, where are you a national? And this can, again, especially in the UK, be both, because you could be a citizen in both countries. And then in that case, the tax authorities will decide. But I've never got into a place like that. I've always been able to see someone's residency up in the questions. So it's just also important to note that residency is backdated to either when you ceased ordinarily residence, which could be 10 years ago, or when you met the requirements of the tax treaty rules. So if you left 10 years ago, we look at that date and not the date now, and that has an impact on the consequences, which is on the next slide. And obviously the consequences of seizing residency is that exit tax that we pay in the form of capital gains tax. And this would be a deemed sale of this person's worldwide assets on the date before they seized residency. So it excludes immovable property in South Africa, or if they have discretionary interest in a trust, because obviously if you have no vesting rights, you don't own the assets, or retirement annuities. But all your other assets will be deemed to be disposed of the day before you seized at market value. So why it's important to note that if you seized 10 years ago already, we backdated, is that a lot of people build a lot of wealth during the time that they're in the foreign country, and they get very worried about that. So just to ease their mind, if you left 10 years ago out of college, you didn't have anything, then seizing residency is really easy because you've got no CGT to pay.
So just as like a point of reference on that, I left South Africa in 2017, but Marisca helped me to cease my tax residence in 2020. So we backdated to when I just come out of varsity and I didn't have any money, and I was very grateful for that.
Okay, so I created a little case study, and this is a very relevant topic at the moment. And this is the taxation of a South African trust with non-resident beneficiaries and non-resident donors. And it's a hot topic at the moment, I would say, because when we originally created trust, it was for a South African family, and no one ever thought that, people will be moving as much as they do. So in this case study, we have a family who spent years carefully building a trust to secure their family's wealth for future generations. They ensured that everything was structured for asset protection, succession planning, and long-term financial security. But what if this trust designed to protect their wealth suddenly became one of the most heavily taxed structures? And this is exactly what happened to the Horizon Trust. So originally it was set up for a South African family, but the tax treatment drastically changed when the donor and all the beneficiaries immigrated. And the result of that is a 45% tax trap that turned a strategic wealth preservation vehicle into a tax liability. So we can now explore how that happened and what we can do to mitigate that. First, I need to explain, just if you can go one slide back, please, Michael. I need to explain how the taxing of trust happens. And in South Africa, we follow the flow-through principle. So our taxing of a trust happens in this order always. So it would always first be the donor. So if the donor donated an income-bearing asset to the trust, or maybe he made a settlement, or there was a gratuitous disposal, then the donor will be taxed on the income from that income-bearing asset if the attribution rules apply. So there's 8 attribution rules, and just an example of one is if you maybe have a property, rental property, and you donated that to the trust, and you this makes 500,000 rental income, and you say, I want my wife and my kids to receive, or the distributions of this rental income to go to my wife and my kids, but the kids they're 5 and 10, which means they're minors. And in this case, the donor will then be taxed on that income, because obviously this was, you want your kids to pay less tax than you would if you got it. And also it could be your wife, if your intention of donating this asset to the trust was that I pay 45% tax in my personal name, my wife doesn't work, let's put this in the trust, and we say that she needs to earn the income on this, I'm going to save a lot of tax. There's an anti-avoidance rule on that. Your wife cannot pay the tax, she'll pay the tax. But if your true intention was that I want this for succession planning, I want it for security, I wanted to continue on with for my kids, then your wife can, the income can be distributed to your wife, because your intention wasn't to avoid tax. So that's just a few examples of when the donor will be taxed on this income. Second will be the beneficiary. So if the beneficiary has a vested right in an asset, for example, they say that asset 1, the income from that asset is vested in beneficiary 1 and 2, they get the income in this, they'll pay the tax on that income, not the trust. Or if maybe in that year, the trustees made a distribution to the beneficiaries of the interest income and said it's split 50% between the 2 beneficiaries, then they get taxed on that income. Unless, of course, an attribution rule for the donor applies, then that overrides it. The beneficiaries won't pay the tax then. And then thirdly, if there was no donor or no income attributable to the donor or the beneficiaries, there was no distributions to the beneficiaries, then lastly, the trust will be taxed on the income at 45%. So what I want to explain on the next slide, specifically relevant to our topic, is Section 7(8) attribution rule that says that if income is distributed to a non-resident beneficiary, then the donor needs to be taxed on this, because non-residents has so many tax benefits in South Africa. So there's obviously some tax leakage happening there. So the problem that we have in this scenario is that the donor is a non-resident now as well, because he emigrated, left South Africa, and he can't be taxed. And for that reason, there's a 45% tax trap, because donor can't be taxed either. So this creates such a big tax burden for an originally structured, like to benefit the beneficiaries of a South African or tax residents of South Africa, and they would have been taxed on their individual tax rate. So that would obviously have been much less. So, and an example to explain that is that the Horizon Trust received R1 million in profits from all its income-bearing assets, and the donor, who's a non-resident, the beneficiary who's a non-resident can't pay the tax on that, because obviously Section 7(8) applies. Beneficiary can't pay the tax. Donor can't pay the tax because the donor left South Africa as well. So now, thirdly, the trust is taxed at 45%, which means 450,000 Rand tax on this income, which is much higher than if this could have been split between 4 beneficiaries, 250,000 each. 26% of 250,000 Rand would have been taxed. So it's much higher, and that just needs to be considered for people who have left South Africa.
I mean, it's a very important topic for a lot of people on this call, that perhaps their parents created a trust for them. They now live overseas and their parents have now passed away. The question then becomes about who are the trustees of that trust and where do they live? Marisca, could you explain the concept of place of effective management and how that would apply to how trusts are managed in that scenario?
Yeah, so trusts can also cease residency if the majority of the trustees are not in South Africa. And it also depends on the day-to-day management exercised by the trustees and also where the key operational decisions are made. So if all the trustees also live in another country, then this trust is definitely going to cease residency. We also need to look at the permanent establishment of this trust, because that can also seize their residency or actually just determine where they get taxed. So certain examples of how you can get a permanent establishment in a foreign country is if you have a fixed place of business in that country, or if you habitually conclude contracts in that country. So I recently worked with a trust where the trustee is a non-resident. He generally signs all the contracts. They have a lot of property, and we had to advise him that he can't play that role anymore because he could become a permanent establishment in that country. So the solution here is that the majority or an equal split of South African resident trustees versus non-resident trustees need to be looked at, and then also just ensure that the annual meetings are held at a physical location in South Africa where there's minute takers and records of location is being tracked.
Now, let's flip that in reverse, where we've now focused on a South African trust where the trustees leave and the place of effective management could become another country. What if I'm here in Singapore and I decide to establish a Singapore trust to hold all of my assets and wealth that I've built offshore, and then decide to retire back in South Africa? Would place of effective management work in my favor if my trustees are living offshore, or if I have professional trustees that represent me offshore?
Yes, absolutely. So it's important to also consider your offshore trust, that doesn't become a South African tax resident, because then you've done all this planning and it's all undone. So it's important to work with professionals who are trustees in that country to keep the place of effective management there.
Because the place ultimately where you establish a trust, if you're living offshore, if you're looking at trust planning and estate planning, something that would be a very interesting concept is understanding the taxation of trust arrangements all over the world and which one would be most beneficial for you, considering your future plans, where you want to retire, where you want to where your children will be living in the future. So where the beneficiaries who enjoy the trust will live, and you then plan accordingly with this rule in mind to ensure that it's ultimately tax efficient. As Marisca says, it's an expensive exercise to get wrong.
Yeah. So how can people mitigate this is, if they are in this situation, is they can assess the trust structure and the future plan. So if all the beneficiaries are non-residents, they need to reassess if this is still a great wealth preservation vehicle for them. They can obviously sell or restructure the assets, which will attract capital gains tax now. But if all these assets remain in the trust, all the growth will be taxed at 45%. So you can obviously avoid that by making plans now, paying the CGT. It would even be better if they would invest the assets in the beneficiaries before the beneficiaries emigrated, because if you have vested rights in a trust assets, that means you own it, and then you will pay the capital gains tax at 18%. So that would have been better, obviously. They can also consider alternative structures, such as they can consider offshore investments, or maybe a tax efficient trust in either a low tax jurisdiction or a tax haven, offshore trust. They can look at things like that. The capital gains tax that they will pay on the selling or the restructuring of these assets would be recovered over time with a great tax plan. You know, if you efficiently plan this, it could be recovered over time. And then also just planning for the future is, I would always advise to get a tax opinion, or just restructure everything. And we can definitely help with the tax opinion and helping to optimally restructure the trust for them.
Just again, antidote on that. Marisca did help me in one of my clients where we structured a Singapore trust with multiple offshore holding companies all over the world. She gave a really great opinion on it, and we were able to act and give the client the right advice on that matter too.
Thank you, Michael. So then just a few takeaways is that a South African trust with non-resident owners and non-resident beneficiaries could easily become the least tax efficient vehicle in a scenario like this. And then also, if the tax status of the trust isn't looked at as well, if the whole family's immigration status changes to non-residents, you need to evolve with that, because failing to plan for that could result in the Horizons Trust scenario. And also, always best if you have a trust, if you can plan that before immigrating, that's obviously the best option always. And also just to note that a trust is not a set and forget structure. It should be regularly looked at, especially if the families move abroad, because it can save them millions in unnecessary tax if it is planned properly. Okay, so this is, I would say, another hot topic at the moment, again, because people created wills and they intended for their children, grandchildren, whoever to inherit from their South African estates, but they didn't consider what this will mean if they all immigrate. And in this scenario, what we have is Mrs. Legacy, who did everything right. She built her wealth locally and abroad. She planned her estate, and she also ensured that her beneficiaries were taken care of. But one overlooked detail nearly locked her legacy in South Africa indefinitely. Her beneficiaries, expecting a smooth inheritance, instead could have faced months or even years in red tape, being unable to get what is rightfully theirs. So we can look at what the scenarios were and what we did to create a better estate plan for her. So her beneficiary one was a South African who emigrated 20 years ago, but she never formally ceased her tax residency with SARS. She lost her South African ID, and she has no record of her South African ID or her South African tax number. So there's no way for us to identify her with SARS, which means that we can't seize her residency. Beneficiary 2 emigrated 20 years ago. He actually did go through the Reserve Bank process of seizing his residency, but he has absolutely no record of that. And he refuses to go through the now SARS process called tax migration or seizing your residency. He's very scared of what that would trigger for him in the US. Then we have beneficiary 3, who was 11 months old when she left. She's Mrs. Legacy's niece. She never had a tax number. She was never a tax resident in South Africa. So what we need to look at is exchange control rules for how you can send your inheritance abroad, and exchange control rules for someone who was registered for tax and had a tax number is that you must either prove that you've ceased residency or that you deregistered your tax number, and then you will need an AIT PIN to send your inheritance abroad. So that's for someone who was registered for tax, must cease residency. So because beneficiary 1 cannot seize residency because of her ID problem, and beneficiary 2 refuses to do so, their inheritance would be stuck in South Africa because we can't send that abroad. Exchange control would just say no. Then exchange control for South Africans who never had a tax number in South Africa, they can freely send their inheritance abroad up to 10 million rand. Or if the inheritance exceeds 10 million rand, we can apply for a manual letter of compliance from SARS, and they don't need a tax number, it's just a letter. They can send their inheritance abroad there. So because beneficiary 1 is the only one who never had a tax number, there won't be any problems for her sending her inheritance abroad. So
Yeah.
did you want to say?
Yes, I was just going to say that, so Marisca touched on it for a moment there. Everyone might have been aware that when you lived in South Africa, you can send 1 million rand a year out of the country without getting a tax clearance certificate. Once you're a non-resident, and this is a new process that was introduced in April of last year, you now have to go through and get an approved international transfer, which is when you work with SARS and the South African Reserve Bank to obtain permission to send your own money abroad. Once you're non-resident, you don't have a single discretionary allowance of 1 million rand. You actually have one of 0. So even if you want to send 10 rand, you can't without getting permission.
Yes. So that's the AIT PIN. Michael, I just want to touch on one topic on the previous slide still. So the strategic plan that we then came up with for Mrs. Legacy is that her niece, who never had a tax number, she changed her will that her niece would inherit all her South African assets because she can send that abroad freely. And then her two beneficiaries with the problems in South Africa, they are inheriting all her foreign assets so that they don't have problems with SARS and exchange control. So the key takeaways is that unresolved tax residency blocks inheritance because non-residents need to formally cease residency before taking their inheritance out. Without a tax number, you can easily send your inheritance abroad. And you need to do proactive planning to prevent these delays in estate planning, because if this was left until Mrs. Legacy passed away, nothing could have been done because her will says, you know, this is what needs to happen. And beneficiary one and beneficiary two wouldn't have been able to externalize their funds. So we were able to help her that way. So again, the lesson here is that estate planning isn't just about a will, it's also about avoiding residency tax traps before it's too late. So again, plan ahead of time.
So before we move on to the next section, so this is actually actual clients that Marisca and I have worked on over the last couple of years. And a lot of these people would enjoy similar lifestyles to what you have wherever you are in the world. And they might also be affected by the same sort of tax planning scenarios. So we wanted to share real life insights of how we help people and to also show how this is, you know, your key strategic way of thinking about your own tax situation when it comes to South Africa, whether you have a really good, you know, you've ceased residence, you've got a good record of that, or if you want to return to South Africa and retire there, etc. So, but before we do, Marisca, we do have a question, and this is quite a typical question that we get every year on a webinar. So I'd like to address it before we get into the case studies just quickly. So, the question says, if someone left South Africa in the 1990s before the introduction of a residence-based tax, what is the implication on that exit given the person never formalized their immigration? And then what happens if that person were to later go back to South Africa and become resident again?
Okay, quite interesting one. So let's say before they are planning on coming back to South Africa, they would need to, if they had to see, you know, had any issues with inheritance being sent abroad, they would still need to seize their residency if they had a tax number, obviously. So they still need to seize their residency. And obviously, if they had any capital gain or assets that attracted capital gains tax, that would be not payable because CGT only came in 2001. So they'll seize their residency. If they then come back to South Africa, we reinstate their tax number. And this is for anyone who left who decides it's not so rosy there anymore, want to come back to South Africa. We reinstate their tax number. And then just something very important to note on that date that you come back to South Africa and we reinstate your tax number is that when you become a tax resident of South Africa, you'll be taxed on your worldwide income again. So you need to then valuate your worldwide assets on the date that you become a tax resident. So all your assets would then in the future be subject to capital gains tax. So it's just important to note that obtaining market values of their assets on the day of becoming a tax resident again.
So I hope that answers the question, but quite simply, if you've ever left South Africa and you didn't go through a formal process of letting SARS know that you're a resident of another country, you should do that, and you should ensure that you have a tax compliance status in South Africa. And if you did leave all those very long years ago, the chances of capital gains tax, as Mariska explains, is quite low. It shouldn't be a reason not to do it. So please make sure you are compliant. So moving swiftly along to examples of clients that we have actually helped. So the first thing that we would like to talk about, this is perhaps something that a lot of people might be considering, is they have elderly parents now, and the parents are now looking at how do they start giving some of their money to their children before they die. Let's give the children the inheritance today so that they can enjoy it. Why wait until I'm gone to only give it to them? So I had a young client who is in his early 30s who had a he came to me and said, "Hey, my mom's got 600,000 rand she wants to give me. Once I get it, what can we do with it? Like, should I invest it offshore?" And I said, "What do you mean she has 600,000 rand she wants to give you?" And he was like, he explained the scenario, and I just made him aware that if anything over 100,000 rand as a gift or donation attracts a 20% tax. And he said, "Oh, well, what do we do?" So Mariska and her team came in and just said, maybe you should consider another way. Do you want to explain that a little bit, Marisca?
Yes. So what we assisted him in is, instead of saying that she must give him the 600,000 rand, that would have resulted in 100,000 rand donations tax that his mom would have needed to pay, which, I mean, it takes a whole six away of his money that she would have given him. And what we then advised him on is, if she would rather give him a loan of 600,000 rand, there's no tax on loaning money to your kids, then she could each year donate 100,000 rand of the loan to him, so he doesn't have to pay that to her. And then if she does this yearly, the 100,000 rand doesn't attract donations tax, which means that she didn't have to pay the tax on that. After 6 years, this loan would be paid off and there was no tax payable. So she made 100,000 rand saving by loaning him the money and donating gradually over time, rather than at once donate it and pay the 100,000 rand tax.
So, look, this is something that would really, it would really only work properly on a relatively small amount of money like this. If it was millions of rands, you would have to have a very good loan agreement and make sure it's all very well documented and ensure that there's a whole bunch of other considerations. So that would, let's leave it at that. But on a small amount like this, a simple loan agreement and forgiving the annual loan repayment up to the donations threshold would be a simple way to give money to your children without effectively paying donations tax. So that was just a quick example of donations tax and using a loan agreement. Now, something Mariska and I helped a gentleman about 2 years ago on this. It came to our attention. We started working with him, and he received an incorrect tax treatment for his foreign income and got an assessment that said he owed SARS almost 2 million rand. In a tizzy, he said, "Why is this the case?" Came to us, and Mariska helped him to figure this out. So why did this gentleman find himself in this situation, Marisco?
So his previous accountants incorrectly declared his income to SARS, and he only got the 1.25 million rand exemption. So this was on assessment number one, got the 1.25 million rand exemption. SARS audited it, and they did not provide the relevant documentation to allow the exemption. So they disallowed it, and he then had to pay the 2 million rand to SARS. But what they failed to identify, that he was a non-resident of South Africa, and non-residents are not subject to tax on your foreign earnings. He was actually a tax resident of another country, and for that reason didn't have to at all declare this to SARS. So we disputed this and provided motivations, the correct supporting documents, and then SARS actually paid him a 35,000 rand refund. So we made him a saving of over 2 million rand, which his previous accountants just said, "Sorry, you have to pay this now."
And when you say that you gave motivations and supporting documents and evidence to substantiate that he in fact does qualify for this exemption on foreign employment income, what were some of the things that you gave or motivated to show this?
So we seized his residency because that wasn't done before, and we could provide his notice of non-resident to residence to SARS, and also just his. I provided all his pay slips, all the tax that he paid there, and everything, just to prove that he definitely didn't have to pay this in South Africa.
So again, this goes back to what Mariska was saying earlier in her presentation, was just explaining that when you live overseas, like, it's important that SARS knows that you are tax resident of another country, or else this could be happening in the background And if you don't have an accountant or tax advisor who's up to speed on these matters, and they don't understand the motivations that need to be made, you could be hit on your overseas income too with a massive tax bill unnecessarily. So again, like I'm saying, I'm not trying to make you scared. If you understand the system and the processes and you work with someone like Marisca and her team who understands this, you don't have to worry because ultimately SARS will pay you 35,000 Rand, perhaps. Um, so another one, and this is something that I've seen a few times from clients that I've spoken to. So they may live overseas, but they are employed by a South African company who then deducts pay as you earn monthly tax from their salary. But they don't live there and they're not tax residents of South Africa. So Mariska, can you explain more about this case?
Yes, so this client was taxed on his South African salary, even though he wasn't even present in South Africa. They deducted pay as you earn every month. So what we did is we claimed his foreign employment income exemption, and we got him a refund of 223,000, which was all the tax that he paid. We have not yet seized his residency. He didn't wasn't sure if that's yet what he wants to do. So we claimed the foreign employment income exemption. So what we can also do for people in similar situations is that your South African employer is obligated to deduct pay as you earn from your salary. They have to do this unless you have a tax directive from SARS stating that they can deduct 0%. And we can help to apply for those tax directives to obviously exempt you from pay as you earn in South Africa, and it will then only be taxed in your foreign country.
Beautiful, because double taxation is not something anyone should have to go through. So,
Yeah.
retirement funds withdrawal. Okay, so now this is where I come in quite a lot. So as a certified financial planner, I have a great amount of experience with the retirement products in South Africa, as well as the legislation that applies to them. And together, Mariska and I have helped quite a few people who have left South Africa with no intention to return, who have built up considerable retirement assets in South Africa to consider what do they do with it? Do they bring the money offshore? What is the tax consequence? Is it actually worth doing that? So we go through quite a lengthy due diligence process with the client where we understand where they're living now. We understand how much is in their retirement plan, in their retirement plans in South Africa. We understand their intentions for the future and where do they want to reside during retirement and the likelihood of return to South Africa. And then we would basically help them by reviewing the products they have, if it is a retirement annuity or a pension fund or a preservation fund, or if it is a provident fund. How do these work and what are your options and what are your tax rates for using these? So before I get into this specific example where we were approached by someone who had just turned 55 and is currently living in China, I want to just ask Mariska, in terms of retirement products in South Africa, if you were to have a provident fund and you were looking at withdrawing it, but you were under the age of 55, would it be worth waiting until after the age of 55, in your opinion, roughly?
So it would be worth it, and generally we look at the age of the person. But obviously there was the vested part and all these parts happening in 2021. So anything that you had in your investment up until I think it was March 2021, that has the old rules, which means at 55, you can withdraw the full lump sum. And after that, it had the same rules as the RA. So if you are close to 55, it's definitely beneficial to wait until 55 and you can get the full withdrawal at the lower tax rates. And because if you withdraw it before 55, then you are taxed at the withdrawal tax tables, and you can withdraw it before 55 on immigration. So then only the first 27,500 Rand is tax free, and the balance is taxed between 18 to 36%. But if you wait until maturity, then the first 550,000 is tax free, and the balance is taxed between 18 to 36%. So it does make quite a difference.
So we've worked with a few clients that are all having their 55th birthdays this year, and over the last 3 or 4 years, and they left South Africa very long ago, but over the last 3 or 4 years, they've come to us and said, should we withdraw these? And we've done the maths, we've showed them the due diligence process, and we've all agreed that they could pay less tax if they simply waited until their 55th birthday. So now diving into this specific case, so basically this person had just turned 55 and they were living in China, and they said, well, look, I've got all these retirement products in South Africa. I don't have any intention of returning to South Africa. Should I bring it offshore? And if so, how much tax would I pay? So in calculating this, we would then go through each product. We would look at the cumulative amount withdrawn and the amount of tax that would be paid. But then I would also help them. I would build a scenario where we factor in, okay, once you've paid that tax, how long will it take you to recoup that money? If you were to factor in other considerations such as investment growth that's available when you're not in a Regulation 28 compliant portfolio. What that means is in South Africa, pension funds are regulated by Regulation 28, and they say you can only invest your money into these types of assets up to these percentages. So if you're not in that kind of restricted environment and you wanted to invest 100% into global equities, you could do that. On top of that, we also factor in then the potential devaluation of the rand into the calculus. And at the end of that, they would have a clear picture on a stress tested scenario, whether or not this is something they should actually do. So when we got into calculating this particular gentleman's tax, Marisca found something that was really cool. So this is what we would call an unranked deduction, and it falls under section 11F. Could you explain that to everyone, please?
Okay, so Section 11F is our contribution deduction. So if you make any contributions to your retirement, pension funds, or provident funds, preservation funds, you can deduct a certain amount from your tax each year. So it's either limited to 350,000 Rand or 27.5% of your taxable income. So if your contributions to the fund exceeded that, then you can't deduct it from your tax in that year, and it's carried forward. So then when you withdraw your policy on maturity or however you choose to do it, the unclaimed amount per year can then be deducted from your value of the lump sum that you're withdrawing before the tax is calculated. So we were then able to, in the calculations for him, identify that, and that was, I think, a crucial part of the tax calculation and the decision also that he could make to withdraw in a certain way.
So absolutely. And basically we through doing a review of his tax affairs, we found this 500,000 Rand of previously disallowed contributions that we said, great. So not only are we going to help you build a strategy where you can withdraw your taxes, but we now have found additional deductions that we can apply that you weren't aware of, Mr. Client. Now, what we then did is we sat and we calculated and understood what he was trying to achieve. So we looked at his Provident Fund. He had never taken a withdrawal before. He had previous allowed deductions on it, and he had just turned 55. That looked like a good one for him to withdraw fully at normal retirement table rates. The next thing we did is then we looked at his retirement annuities that he had, where he had 3 of them that were above 247,000 Rand. So we said to him, right, why don't you retire from these, take 1/3 in tax-free monies out, take 1/3 out as cash, and then we commute the remaining 2/3, and we put this into a living annuity to cover your other costs in South Africa. So he had insurance policies and he was looking after parents and all kinds of other things. So we just said, right, so that pocket of money, keep it in South Africa and make it a passive income to pay these needs that you have. Through doing this, because he lived in China, Marisca did a review of the double tax agreement between China and South Africa. And basically we found that the income would only be taxable in China. And this comes back, Marisca, correct me if I'm wrong, to you and the tax directive where we get it taxed at 0% and you tell the retirement houses about that. Is that right?
Correct, yes. So a tax directive will be issued for 3 years, and then every 3 years you can apply for a new one, and the fund house will then deduct 0% tax in South Africa.
Now, interestingly enough, according to our research at the time, the Chinese wouldn't actually tax overseas pension income either. So we found by applying this double tax agreement, he would be in quite a positive position so long as he remained a tax resident of China. We also told him if he left China, this could change. So it's not the main reason to do it. And he agreed. And then the last thing is he had a retirement annuity that was less than 247,000 Rand. So he was allowed to take it all out in full without restriction. But this was subject to withdrawal tax. So through this very comprehensive scenario, we were able to understand his tax position, the products that he have, and help him build a strategy to come to a decision on how best to achieve his objectives. And his objectives were to take out the maximum amount of money that he could from South Africa in the most tax efficient way possible. Next was to provide a sufficient passive income for his remaining costs in South Africa. And next was to utilize the provisions of a double tax agreement of his country of residence to his advantage. Now, we have a few people that are in the UAE, perhaps living in Dubai, that might be considering a similar exercise, Mariska. How does the double tax agreement of South Africa and the United Arab Emirates apply in this sort of scenario?
Okay, so when they talk of pensions, similar remuneration, and annuities, we look at Article 17, and that says how these should be taxed. And according to the DTA, it may be taxed in South Africa. But they don't talk of a lump sum here. So lump sum income is taxed under Article 21, other income. And the DTA says that a resident of the UAE who receives basically this lump sum shall only be taxable in the UAE. So in that case, when the lump sum is withdrawn from South Africa, it's going to be subject to tax, and then that can be disputed to request a refund for the tax that was deducted just because of the DTA and how the wording is.
So in order for that to work and to qualify, you have to be a tax resident of the United Arab Emirates to enact that double tax agreement. And do you have to be tax resident at the time of the withdrawal to apply it?
Yes, yes. So you will be, because remember that if you want to withdraw your retirement annuity, you have to have been a non-resident for 3 consecutive years. So if they went to Dubai, then by the time they can withdraw this, they would have been there for 3 years.
Absolutely. So, but what I'm getting at is if you had lived anywhere else in the world for more than 3 years and you said, I want to pull my pensions, move to Dubai, enact a double tax agreement, you can't do that. You have to be a tax resident at the point in time you withdraw to enact a double tax agreement. And that's how that would work. So everyone, we've just touched 1 minute over our finish time. And we really tried to pack this full of insights, case studies, the budget reforms, all of that. It's a huge amount of information. We understand that. So I just wanted to share my contact details very quickly. It's a QR code. You can scan it. It takes you to my LinkedIn. We can connect. You can send me a message. You can see some of the articles and publications that we put out, as well as other webinars that we will be hosting on different content. And then, Mariska, obviously, this is your website. Would you like to share your email address with everyone too?
Yes, so it's Marisca at mintaccounting.co.za, and Marisca is spelled with a C, so I'm not sure if you can see my name on my picture. It's Marisca, not Ka. So you can email me. I'm also on LinkedIn. You can look me up on LinkedIn, and our website also has all our information.
And it's a very nice website too. I think you guys did a great job there.
Thanks.
So everyone, before you drop off the call, if you have any questions you would like to float to us while we are here, we have made our schedules available for another 10 minutes or so to answer any specific questions. If anyone has anything, please put it in the chat. And if not, we will end it here. So I'll just wait and see if any questions come up. All right, great. So there is one question here, and I'm not sure if I understand it correctly, but I'm going to try my best. So it says, what is the situation if you are employed internationally and you pay tax in place of employment, but you live in South Africa? So I think what they mean is they have an overseas company that employs them, pays them an income, they pay tax in that country, but they reside in South Africa. Is there any tax considerations they should make? Do they have to declare that income and that tax paid in South Africa?
Yes, so they will be subject to tax on that. It's worldwide income, and then they'll be subject to tax in South Africa, and there will be a foreign tax credit available for the taxpayer. They won't pay double tax. Either countries will give him a foreign tax credit.
Very good. I know who asked the question, and again, I'm going to follow up with them and tell them they have to meet with you because I've been telling them that for a while.
Yeah.
One more question is, once SARS is aware that you are a non-resident, do you need to notify them periodically, or only if you choose to move back and become a resident?
So you notify them once that you've ceased residency. This will change if you go to a country where there's no double tax agreement with, and it depends on how you ceased residency. So it has to be, it depends on your circumstances. It's not a one size fits all answer, but generally it should be that you inform them once, you stay in that country, and when you come back to South Africa, you'll inform them that I'm a resident again.
So just on that, as a follow-up, in someone, let's use me as an example. I ceased my tax residence, but I didn't deregister my South African tax number. And every year we still file a nil tax return to uh, SARS, and we notify them that I'm still non-resident that way. Is that necessary for everyone if they want to keep their tax number open?
So, generally, if you're a non-resident and you don't earn any income in South Africa, generally you should not be submitting a tax return. But we used to get a lot of admin penalties for not submitting that. So we're just advising all our clients to submit a zero tax return to remain compliant, because to get rid of that admin penalty, which can be anything from 250 Rand to 16,000 Rand per month, for not submitting that. So sometimes for us to dispute that admin penalty, our fees are more than just paying the admin penalty. And that's so unnecessary to pay admin penalty to SARS when you didn't even earn any income. So we just advise everyone submit a nil return and remain compliant.
Yeah. So also for everyone still on the call, Marisca's annual tax compliance. So filing an annual tax return is very, very affordable. In Sing dollars, it was less than $200 for her to do that for me every year. It's a no-brainer, so I just do it. And an additional question that was raised is, what happened, in addition to this, what happens when you are earning income in South Africa, example, rent? Um, all to put it bluntly and simply, all South African sourced income would be taxed in South Africa first before being taxed anywhere else in the world, if being taxed at all. Is that right?
Correct, yes. So even if you cease residency, your tax treatment would then be that you are not subject to tax on your foreign income, but you are still subject to tax on your South African sourced income. So rental income will be taxed in South Africa. Interest income, certain interest will have an exemption. So if it's from a bank or an institution, non-residents have an exemption on that. But if it's a loan with your company or your trust, there will still be tax considerations, and dividends also still have tax in South Africa. So you're not completely off the hook, but you don't have to declare your foreign earnings to SARS.
So again, to make it simple as like a simple rule, if you are a non-resident, your South African cited income or sourced income would likely be taxed in South Africa first. There are exceptions to that rule. The most common one being interest from an interest-bearing account at a bank. So yeah, that's an important consideration. Do we have any other last minute questions that anyone would like answered? See, we still have 15 people on the call, so that you guys are the bitter einders. Very good. All right, guys, that looks like everything for the evening. So thank you very much for joining us, and yeah, we'll be in touch with you. We'll send the recording. Thank you so much.
Thanks so much.
Cheers, Mariska.
Bye, Michael.